Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. We have with us Jeff Keltner, who is the SVP of Business Development at Upstart. Upstart is an awesome fintech lending company. I'm really excited to learn more about it and share Jeff's story through technology and fintech and all of his other career opportunities. With that, Jeff, welcome to the podcast.
Thank you for having me. I appreciate it.
It's my pleasure. I think it's a really interesting moment to talk about the lending asset class and interest rates and inflation and, capacity to pay. But before we jump off the cliff like the British pound, maybe let's start with the beginning of your career. It wasn't in financial services, it was in technology. So tell us how you got your start.
I got a computer engineering degree. I'd say about halfway through my degree, I realized that I was good at technology, but not as good as the other guys. And so I've kind of built my career at the intersection of technology and business and sales, marketing, business development, but always with technical products and always with a little bit more technical edge. So I started off selling, believe it or not, what you could roughly describe as a mini mainframe at IBM. So that was then called the AS400. And then jumped to Google. And I think it's very fortuitous timing was there for the launch of what's now Google Cloud, but at the beginning was just Gmail for businesses and schools and ran that business, the school side of that business for a number of years. And then, the leader of that business, Dave Gerard, left to found Upstart. And I was ready for my next adventure. So I called him up and said, hey, what are we doing next? And I've been here for the last 10 years.
If we spend a little bit more time on technology and sales, can you talk about what that functions like? Like, what are you trying to achieve? And what are the ways in which you're trying to achieve those goals? Like, what are the motions or the practices that you picked up from Google in selling technology first, software products?
Yeah, it was really fascinating to go through that experience. And that was really, I cut my teeth at IBM in there. I think the first thing is understanding how you connect technology to business value, right? So particularly as an engineer, you can lean into just wanting to sell the tech, how cool it is, what Steve Jobs might have described as speeds and feeds and why you're better than the next guy. And there's an audience for that at every company, usually the IT department, who's going to compare you to a technical level. But what we really learned at Google was how to sell at a business level. So very simply, back in the old days when everybody was on, these terrible email systems and you couldn't send attachments and it was large email boxes and large attachments and never deleting and searching and finding. And so it was really about how do you move from the technology itself to what the technology does for the company or the end user and how it makes a business value for that customer. And that's really the gap a lot of people struggle with is how do I go from what my technology can do to what's the business value to my customer of what my technology can do. And that's what we had to get really good at. And I think anybody trying to sell technology to banks or into fintechs or anywhere else has to understand not just the technology and be able to compete against your competitor and why your solution's better, but how do you really ultimately drive business value for your users and for your customers?
There's a challenging point in there that a lot of finance people struggle with. And certainly for fintech, there's people who grow up through, like a Wall Street program and capital markets and banking, and then joined fintech or joined the DeFi trends because they want to add tech to their finance background. And there's a set of assumptions about what's valuable when you're kind of educated in that way. And then there are folks with your background who start in tech and see that the software is the thing and the people who are building the tech, that's the product. And then you just deploy that model in finance or in a financial sector. How do you think about those two directions? Because there's quite different mindsets, don't you think?
I do. And I think we sometimes talk about the fintechs and the tech fins, those who are really technology companies targeting their technology development at the finance industry versus those that are really, finance companies, run like finance companies that target, adding a little technology. And I think they end up very different approaches. One of the things we focus on at Upstart that I think is indicative of the technology-centric approach maybe two, I'll say. One being the speed of iteration, right? Technology companies want to be releasing product daily, hourly, in real time, multiple times a day, and iterating their way to the right thing with real data. And finance companies, banks tend to be like on a 1 or 2 year release cycle, right? Like we upgrade that system every 5 years. And I think that's a key indicator for people. And if you're building technology, it's so hard to have such a slow learning cycle. The speed to learn and iterate and improve, and it just has to be rapid. And I think that's one of the things you'll see as a difference between those two. And we've found this as we've hired people with more, we've had some employees that come with more of a finance background, is the sense that who's your real customer? I mean, we're in some ways, lending is a two-sided marketplace, right? You have people who need money, you have people who have money, and you're trying to combine the two in some way, right? Like, and make a match. And any two-sided marketplace, you have to ask the question, who is my primary customer? Like, which side of the marketplace's needs drive ultimately my product development and my strategy? And I think very often, financial services companies tend to start with the capital markets or the capital side as the driving force, right? Like, we'll often hear, well, what kind of loans do people want to buy? And then let's go figure out how to make those kinds of loans. And we tend to, the technology-centric approach tends to be a consumer first, right? A user first. We go, what kind of loans do people need? Like, what do they need in their lives that we can solve through a lending product? And then the second order problem is, how do I go find the right funding sources for that? And so I think it's like an inversion of how you think about the value chain and what your ultimate goal, your ultimate customer is, from being that capital side to being that consumer side. I think it's a big difference in how people approach these things and drive strategy. And they take you to two very different places.
Is it ever frustrating for you to be, I guess, in market with people who think so differently? Like, when you do have this convergence from different sides of industry and you have different disciplines coming together and sort of people end up overlapping in the middle from quite different backgrounds, there must be a lot of stuff that can get lost in translation. Does that ever get challenging? And if it does, how do you bridge that? How do you get around it?
If you think about it from an industry point of view, it doesn't bother me. Like, we stay focused on our customers, not our competitors. So the fact that other people view it differently, it doesn't matter. Obviously, our customers have different points of view. And I think you just got to learn. I sometimes describe my role often as just being a translator between sometimes our machine learning approach to risk and AI and, traditional risk. And like, I got to go and explain the AI thing to the credit risk people at a bank because they don't speak the same language. And it's not that they disagree all the time so much as they just aren't always talking in the same way. And so I view that as part of what I've always enjoyed doing, is being at that intersection. It certainly creates frustration. And, a simple example of that for us would be when you have an AI-based underwriting, you find a lot of borrowers who are creditworthy who don't look that way to a traditional lender, right? That's kind of the whole magic. One of the whole things that got us into the business was, the study we did with TransUnion that showed that 80% of the American public, had never defaulted on a personal credit obligation. And yet less than half had a prime credit score that would get them access to bank-type loans. Well, that's crazy. We should be able to go close that gap. And you can find those people through an AI underwriting model, but then you have to convince the banks to actually make the loans and the funding sources to actually own those credits. And that's like a process, right? It's an iterative process of, proving that you're working on the margins and then expanding where that is. And it can be frustrating, right? You have these kind of artificial barriers placed on you in terms of, well, Jeff, we really trust your model, but we don't want to go below a 660 credit score. And I go, well, the whole point is that there's good people below 660, but you start within that constraint and you earn the right. That same, customer will call me up a couple months later and go, Jeff, you're really right about these 660s. Let's try 640 to 660 or 620 to 640 and see if you can find some good borrowers in our credit spectrum down there. So you have to find a way to work with those partners. You have to find a way to earn the credibility over time and build your strategy as a business around the fact that you're not going to be able to do it all at once, right? That you're not going to start with a blank check. You're going to have to build into that as you prove the model and prove your value and prove your partnership with the people you work with.
That definitely takes us to Upstart. Just for context for our listeners, Upstart is one of the few kind of pure play digital lending companies that are public, give or take a $2 billion market cap. The company was started in 2012. Is that right?
That's correct.
2012. And just fantastic growth. Last year, revenues were around $850 million for the year. So this is a big machine that got built over a pretty fast amount of time. And you've been there for the whole journey, really. Yeah. Can you talk about the very early days? Like you've described kind of the problem of telling a bank and kind of their model and so on. And I also see a lot of discussion of artificial intelligence as it relates to lending, but this is 2012. What was AI then? Like, what were you seeing? What were the early green shoots of what the opportunity looked like?
Yeah, I mean, if you go all the way back in our history, we actually started with a non-traditional loan product, what's called an income share agreement. So for the builders out there, this was we're going to give people capital in exchange for a fixed portion of their income over a fixed period of time. And there's upside and downside sharing with the investors. And we did a little bit of that and really learned over time that there was both a limited market on the consumer side and an extremely high risk premium on the capital side for this product people didn't understand. And so that was our idea. It's like lending is, kind of like VC, but for early stage careers where you can really invest in an individual, a lot of it being used to refinance educational debt. And we just didn't find a product market fit. And so we said, hey, a lot of what we do in this model is, the challenge of an income share agreement is figuring out how much someone's going to earn over, let's say, a 10-year term. So what percentage of that income should you ask for a $10,000 upfront capital distribution? And it's the same, if you think about that, we take that and say, well, what we're really doing is predicting someone's income stream, which is kind of one of the most important things in predicting somebody's ability to repay a loan. And so we pivoted pretty substantially from that product. We sunsetted that product and started an unsecured loan product where we were really applying some of the same thinking we'd done on predicting income, stability of income, et cetera, to the lending product. And then we found that there were just many people that were underserved by traditional lenders. And even I'll put the early stage digital lenders into the category of traditional lenders in that most of them were worried about digitizing the application process. They were not thinking in any real way about changing the risk analysis process, right? They said, hey, there's this way we do stuff. Everybody's going digital. Let's take the form. Let's make it a digital form. Then it'll pop up on a digital process for the underwriter and they'll do the same thing they did before, but now it's digital and it's fast. You don't have to come to the branch. And that was all great. And we really aimed ourselves very squarely at that's not enough. How do we change the underwriting decision with a smarter answer? Nobody was talking about, people were talking about AI back then. I don't think we would have described our first models as AI, but we really, as we started to do studies like the 80-45 and realized, hey, we're approving more people, but like way fewer more people than are actually creditworthy, right? Like there's still a huge gap between what we can do and what the reality of risk in the world is. And so we set our minds really fast onto solving that particular problem and applying the most sophisticated ML. We kind of had this, it was one of the early kind of intuitions was, you're talking often about young people who don't have a credit history, right? And companies hire these people all the time and they have a really good model for like, what's a good employee going to look like? How do we find the right people to hire? And yet, if you were 22, right, coming out of college or 18, coming out of high school and applied for a loan, they would just go, no history, no credit. There's all sorts of things we look at that aren't your credit history that can indicate whether you'll get a job. And by the way, whether you can get and hold a job is kind of the key thing to figure out if you can repay a loan. And so we started down that path of how do we look at some other points of data? How do we use smarter models to understand what it means to have a high credit score, but also a high debt to income ratio? How do I balance those things in different contexts? And just started down the process of how do we build a model that can understand creditworthiness in a much deeper level. And that, to your point, like most of our growth, it's been a kind of a crazy ride for 10 years, but has been driven by improvements in our ability to understand creditworthiness and make credit either more accessible or easier to get, to make the process of proving your identity, proving your income simpler and with less friction. And those improvements in the model have been substantial drivers for our growth over the years.
So there's a couple of things I want to pull at there. One of them is actually a reflection of what you described as like a technology product going after product market fit and then capital flowing towards where capital is needed, right? Because the income sharing sort of story of underwriting somebody's career early on and smoothing out their consumption, it's a really interesting one, but it's one that I think, like you say, ends up failing the sort of enough people care or enough people have this problem. At the same time, there is a giant kind of demand pool for personal loans. And so you're kind of shifting the direction from, oh, this is an interesting problem that we might have a separate solution for, to actually our unique solution, our approach to underwriting the person rather than the particular stream of, financial information can also be used for the more traditional product for which demand is pretty much infinite.
So infinite market demand would be nice, but I don't feel like it's infinite. But yeah.
You don't think so? Is there a point at which Google ads are just $100 a person?
Yeah, and that's, I mean, one of the really interesting things about an AI-driven growth model is the kind of virtuous flywheel effect you get, which is your model gets more accurate. It allows you to approve more people. Your cost on Google AdWords goes down on a per loan basis, right? Because you're approving more people. The same thing with reducing friction in the process. If you can increase your approved to converted to loan rate, then your marketing costs go down and you can afford marginally more marketing at a profitable level. And it kind of feeds itself in a very virtuous cycle. But I don't think any market demand is infinite. Personal loans is a lot bigger than income shares, but it's also important to keep in mind that it's almost the smallest product category in consumer lending in the United States. So we don't think of it as an infinite market. And we definitely think that what we're doing should be applied to many more areas. We've started doing auto refinance loans, auto purchase loans. We've got a small dollar loan product that's meant to compete with payday as a much more rate effective alternative. So we focus a long time on the unsecured personal loan space, and that's a much bigger market than we started in. We also are cognizant that it's not the big part of the market in consumer lending, and the same thing we're doing there can be done to every category of consumer lending, and we certainly want to do it.
I want to go into those other categories in a second, but I do have kind of a silly and nagging question around. It's a silly question, I promise. One of the things economists are able to do, and sometimes have to do, is to estimate the value of human life. And you do this, for example, when you're figuring out how much public funds to outlay on safety, on reducing emissions or reinforcing some bridge or sending funds to medical facilities or whatever. You need to have a plug for the value of human life. And it sounds like if you're doing a bunch of underwriting for different people's ability to generate income, because you need to know that because you're going to take a slug for income sharing, then you're inevitably building out a discounted cash flow of somebody's entire career. To me, that's number one, morbid, of course, but also fascinating, really, really interesting. I wonder if you remember any anecdotes or any insights about kind of what emerged out of the data for, typical earning power, what the different levers were, and kind of how the business thought about these things at the time.
Yeah, it was interesting. We never went out quite as far as like full life. And I think you're right. There's a lot of places where we have to put a value on human life, but it's not a purely economic calculation. It's just not like the discounted cash flow of expected income is not the only thing usually that's taken into account in those calculations. But yeah, we did have interesting discussions about some of the things we learned. One of the areas that we actually had policymakers really interested in the model was in the context, a lot of this was used to fund higher education or to refinance higher education debt, particularly for people who wanted to take a high risk, high reward career path, say be an entrepreneur. And they said, well, I can't afford the fixed monthly payment on my student loan, but I'm willing to I'm willing to make my loan more expensive if I hit it big as an entrepreneur, is for the offset of making my loan extremely affordable when I'm taking a low income as an entrepreneur. And so that was one of the key use cases. One of the things that was really fascinating was how do you feed back information to schools about what studying certain things or getting certain grades or going to certain schools says about your earning power, right? So we had a lot of policymakers who were very interested in the kinds of models we had built with the context of helping people understand the ROI on different choices they could make about their higher education, right? Like, what school do I go to? What do I study? What's that going to mean for my earnings? What's that going to mean for what portion of my income will go to pay a student loan, right? If I study art history versus studying, and this is not a bag on art history versus computer science, but those were things that I think policymakers were really interested in because there was such a focus on value for money in that category. It really put in stark terms what would happen, what the economic implications of different choices were in higher ed. My wife always thought we should use it as a dating app, that you could see someone's earning income. Estimated income over time would be a great addition. We should sell the model to like Match.com or something, but we never went that route. But we definitely had some conversations with people in DC about feeding that information into ways to help people make smart choices about what they wanted to do with higher education.
The income-based dating app is more morbid than the life expectancy bit. I mean, that's a great Dark Mirror. Black Mirror episode,
it would be a great episode of Dark Mirror, and I certainly think a popular feature among a certain population, but it was not what we chose to do with our models.
Too dangerous. Okay, so switching over to I guess I have a couple of directions we could explore. One is, what is an artificial intelligence model? Is it like, what is it really? What is the machine learning stuff that the algorithm is doing? And then, are you running 500 of them and discarding the ones that don't perform? And as you go into new asset classes, like what changes? So maybe we can start with that. And I think after that, I'd love to expand into the other asset classes that you're exploring and then how you work with banks, but maybe just laying down super basic, what is a machine learning model in this case, and then how is it used in the business?
Yeah, machine learning at its core, like you could take a linear regression, and that is technically a machine learning model, right? Like it's a machine learning from historical data to make predictions about the future. In practice, what we really are talking about is, using more sophisticated model techniques that I think of as having a couple of real advantages over more traditional approaches. And to put it in really simple terms, we use primarily extreme gradient boosted trees today. We use some neural networks, or we're playing with neural networks. We are always testing out new versions of models, new iterations. Of course, some of them increase accuracy, some of them don't. Some of them increase accuracy at high processing cost that's not worth it. So we're constantly pushing the boundaries of that. But the things these models are really being asked to do, I think it's important to think about the data you're bringing in, what the model can do, and what you're asking it to predict. We're bringing in, if you think about a credit file, most people look at a handful of variables coming off of a credit file. We get almost 1,000 from 2 different bureaus. And then the question becomes, okay, I've got 1,000 variables. We ask a bunch of questions on the form that people don't ask that are more variables. We have, over 1,600 points of data on an individual application file. And then the question is like, well, how does one use 1,600 data points in the traditional context of like a hard rules and a table for rates? Like it just doesn't even compute how you can take advantage. But these variables have really interesting things to tell you. In particular, what machine learning models and AI models are extremely effective at is understanding how to weigh off different variables in different contexts. So a low debt to income ratio would be a good signal. A high credit score would be a good signal. But if I have a high credit score and a high debt to income ratio, does that matter? Does it matter what the debt to income, what kind of debt is in the debt to income ratio? Does it matter how much total money I make in that context, right? Like a high debt to income ratio, but a high income would tell you more free cash flow at the end of the month, but also says you got a lot more spending. So, you've got all these variables that don't all point in the same direction, and you're trying to understand in the most holistic way what's the real risk. And that's really where AI models excel, is taking all those variables that are all telling you little bits of the truth and combining them to get the best holistic picture of what the truth is. And then you ask the question like, well, what's the truth you're asking? And this is one of the really interesting things. So maybe for people who are thinking about building AI models to predict things, it's a really interesting and difficult problem to start working on, because you don't have enough data to actually make sophisticated predictions. So in the beginning, maybe we were making something like a will default, won't default binary prediction, right? And then applying some sort of a standard timing curve to when the default might happen, and then coming up with like what interest rate we should charge. But that's not really what you want the model to tell you, right? So then you might get the model to say, hey, we got enough loans, we can start to do probability of default. Give me just not a yes, no, but like a 1%, 2%, 5%, 10%. Right? What our models are doing now is much more sophisticated, which is weighing off for every period of a loan. So in our case, every month for 3, 5, or 7 years, there is some probability that you make an on-time payment, some probability that you go delinquent, and some probability that you make an early repayment of your loan. And those 3 probabilities must add up to 100 in reality. And so we're really asking our models now to make a month-by-month prediction of what the likelihood of each of those 3 events are for each borrower. And by the way, not just for each borrower, but for each combination of borrower, amount borrowed, and duration of loan. Because we really see this in the extreme in unsecured loans, where we have, a $1,000 loan over 3 years and a $50,000 loan over 7 years. And like, those are just very different risks for the same person, right? So you don't really have a risk of Jeff. You have, how risky is it to lend Jeff $2,000 over 5 years versus $50,000 over 3 years? And those are very different answers. And so over time, we've both increased the complexity of the model itself, but also increased the complexity of what we're asking the model to predict. And that requires more data, right? You need more data to be able to make more fine-grained predictions, to use more of the variables to predict something more specific. And so we've really grown in our sophistication over time that way. And that's kind of that virtuous cycle. But it is, the machine's learning, but you're also learning and building up enough history and data points to be able to make more sophisticated models. So it's a real ongoing iterative process that we're in the middle of. But that's roughly speaking what it looks like for us and where we're headed. and your model forms change, right? We started off with, more simple trees, moved on to extreme gradient boosted, which is kind of a more sophisticated version of decision trees, and are playing with things like neural networks now. So that your ability to take advantage of more sophisticated model types also improves as your data sets improve and as your sophistication and how you use them improves.
That's super interesting stuff. I think it's tough without being in the industry or being fairly focused on artificial intelligence to get intuitions for these things. And I think for me, at least, I've looked at image recognition to get an intuition, right? Like when you ask a computer with machine vision in 2012 to identify a cat in a photo, it'll make an error, let's say half the time. By 2014, it makes an error 10% of the time. By 2015, it makes an error 3% of the time, which is better than a human being's performance, which is around 5%. So you get to a place where image recognition in 2015 has less error than human performance. And you can imagine underwriting to be not all that different from analyzing some mathematical graph of pixels of a cat formation versus some mathematical graph of, people's ability to pay. The crazy stuff starts happening, which is by 2016 and 17, you can now have computers hallucinating cats and creating photorealistic cats that are very pixelated. In 2022, you can have sort of full cat rendered paintings and a dolly. Yeah. And then in 3 years, we'll be watching entirely rendered movies. The question for me here is by analogy, can you talk about the evolution of the machine learning in the financial services space? And definitely in terms of, the lending work that Upstart's doing, but also, more broadly, how do you see artificial intelligence applied and evolving in fintech? And is there a similar progression as we see in these more visual fields?
I don't know what the equivalent of determining cats and dogs is or Dolly is in financial services, but I will say, yeah. So maybe I'll give you the areas we apply machine learning today. It's just illustrative. I think you can start something simple like underwriting is kind of a uniquely well-suited problem to AI, right? Like you've got a very clear answer, kind of like cats and dogs. Somebody goes through and tells them, is this a cat or a dog? Well, a loan either repays or it doesn't. So at the end of the term, you know what the right answer was, right? You have a pretty good set of what we'll call training data that's labeled with very clear answers. Other machine learning problems are really hard because they don't always have that. So, we use, for instance, now, after we set up machine learning, we set about underwriting. We said, well, the other part of lending that kind of sucks is like it takes a while and it's like a pain and they make me upload all these documents or bring them in. Like, we need to figure out if this person's really who they say they are, if they're trying to lie to us about something, if they really make the amount of income they make. What are ways we could apply machine learning to that problem, right? And you start to find that you can combine all sorts of digital signals to get real fine-grained predictions of is this a fraudulent application or not, without asking somebody to like upload a picture of their driver's license or a statement of their rent to prove that they really live at the address they gave you, things like that. So you start to take friction out of the process. And that really means for us going from asking borrowers to provide documentation for things to a world where we can instantly approve them based on digital signals without them having to provide any documentation, right? And that happens in over 70% of our loans today. And that was zero in 2016, right? So that was hey, we got this AI thing in underwriting. How do we apply it to, simplifying the process here? If you take that to secured loans or anybody who's gone through a mortgage, right? If you think about how long that process takes and how many documents there are and how many silly things, I think there's lots of ways you can apply AI in those areas, right? And then you get to more interesting stuff, and not more interesting, but farther afield stuff. Like, how do I get to, we envision a world from a lending point of view where every American consumer is pre-underwritten for every kind of loan they might ask and could have instant distribution of it, right? Because I've already provided, how many times have you been through a loan application process and a bank that you work with is asking you for all the information you provided the last time you got a loan from them or when you opened your checking account? And so how do we get to a world where, hey, I already know all this stuff. I can pull your credit file. I can look at all the data you have. I'm going to have you pre-underwritten for every kind of loan so you can come in and have instantaneous access to credit whenever you need it. Like, that's a pretty different world than the world we live in today, but one that's easily imaginable. And I think some of the really interesting and harder to work on stuff is on the spending and budgeting side, right? Like, how do I look at what someone's spending, look at what they need to be saving, and help them make smarter choices about when to spend, when to save, how much, how to manage the excess liquidity they might have in a given moment, and then access credit when they might need it, those things are really interesting. And, we haven't seen anybody really tackle that space well. If you think about the PFM space, there's a lot of apps, but none that have really innovated in what it means to help somebody manage their finances, right? And we still live in a world where the majority of Americans can't put their hands on, $400, $500 in the case of emergency. So I think, that space is harder. Again, it's not like lending where there's like a very clear answer. Was this a good loan? Was it a bad loan? I can learn and do better in the future. That's a harder problem to apply. But I think in the same way you go from determining cats and dogs to making a movie out of a sentence. We actually have access. My wife got access to DALL-E and we were playing with it last night, and just give me a Pablo Picasso rendering of a beagle playing a guitar. And darn if it doesn't look like that. That's pretty amazing. I think we're going to get there on the budgeting, spending. How do I make smarter decisions to prepare myself for the future? How much do I need to save to retirement? How much should I be saving now to set myself up for the kind of retirement I want? Those are really hard questions to answer. And right now, we don't do it that well, but I see AI coming to really help people understand their choices and decisions and make better decisions about how to plan for their future. And that's a very much different and harder problem, but I think one that will be solved faster than probably people think from an AI point of view.
Yeah, it's both a utopian statement, but also a dystopian statement. Because if we do have machine scale AI engines telling us how to budget in the best of ways, in the way that social media tells us which things to pay attention to, I think it's very possible people will be, financially better off, but I wonder what will happen to the human capacity to make mistakes and live in error. But I guess that's the existential question for artificial intelligence in general. I want to transition us actually to the question of banks, because it does touch on the role of banks. It touches on the purpose of them, what they add to the fintech equation, what they add to kind of the consumer equation, what their purpose is. And then, of course, Upstart works with banks, or was working with banks in the earlier days. So can you talk about sort of how does the company relate to the financial industry today, and what are the wins there?
So we do today, and we have always worked as a partner to banks. I think the purpose banks serve, other than, as a highly regulated entity that does important things like make sure that when you put money into the bank, you can actually get it out at the end of the day. Yeah, I think they serve an important role from a consumer's point of view in bringing together disparate financial services. And hopefully that kind of vision I shared earlier of instantly underwriting any American kind of depends on the financial institution that you're asking for that loan from to understand who you are, which means providing them information. So using the same institution for multiple products should make it much, much easier for you to get them, because they already have asked you about your income, and they've already validated that you are who you say you are, and they have some trust in you because you've interacted with them. So I think there's a huge role to play. I think many fintechs need to make a choice between becoming a bank and being a partner bank. And we pick the choice of being a technology provider to financial institutions as opposed to being a financial institution. We felt like our real sweet spot and our competitive advantage was the technology we could provide. And, some people find that an odd choice, but I think that the industry of providing technology to financial institutions as opposed to financial institutions all building it themselves is as old as technology is, right? We've got sets of core providers, sets of credit score providers that all the financial institutions rely on. And we felt like we could better serve the whole market by working with all financial institutions that we could by trying to compete and only serve those consumers who chose to work with Upstart as opposed to work with the banks that we partner with. So that was a choice we made. I do think if you're, depending on your strategy as a fintech, you may find that it's easier ultimately to become a bank, that having a single bank partner that you kind of front is a difficult position to be in long term, because a lot of the kind of levers of your success are outside your control. So that's how we kind of view the market. And we've actually really enjoyed working with banks and credit unions. I say banks, but I do mean banks and credit. We work with a lot of credit unions too. And we love our credit union partners. So that's been a very fruitful path for us. And we did start, kind of to the people building fintech companies. We started with one partner bank and Cross River Bank, really needed to prove out our models, prove out their efficacy. Didn't want to do that with lots of banks asking us detailed questions about the model and going through regulatory reviews. But as that became more mature, we work with dozens of partner banks and credit unions now and are signing up more, every quarter. And so that continues to be a strong part of our business and something that we felt like we kind of had to work our way into in terms of maturity. But we're, clearly at that point now where we're working with lots of institutions and we feel like there's a lot of power in bringing the capabilities of our technology to the widest set of consumers by working with the banks who already work with with all those consumers. And that was just kind of a natural fit for us for how we wanted to go to market, as opposed to saying, hey, we're going to attract consumers away from the banks to use us instead. And then we'll be able to serve that segment. We want to serve people who are working with banks, who are working with credit unions, across the country. And that means, distributing our technology and its capabilities as broadly as possible within the financial services sector.
So as we think about the growth of the company from the personal credit category to other products, what's the push and the pull? Like, is it your bank partners are saying, oh, we need help with, this is great, can you do this for mortgages for us? Or is it that you're deciding, okay, we want to get into auto loans or we want to get into homes, and so let's focus on that? Like, how do you figure out where to expand given your business model?
Yeah, it's both, right? So our partners call us all the time and go, hey, we love your technology on X product. And we have to look at, what do we do well? Like, so if you think about why personal unsecured loans, as I said earlier, it is the smallest category of consumer credit in the United States. So like, why do you target the smallest market when you start? It seems counterintuitive, especially to an entrepreneur. And the real reason is because of the lack of collateral. The underwriting is more critical in unsecured lending than any other kind of lending, right? There's no car to get back to get your money back. There's no house to foreclose on to get your money back. So the criticality of that first underwriting decision and the lack of collateral for it means you've got to be really good at understanding ability, likelihood to repay a loan. And so that was a place where our technologies would give us the most advantage versus a traditional approach, because it was all in that decision. As you get to a home with 20% down, there's a tremendous ability to be wrong about the ability to repay and still get your money back. And so the advantage of our technology is somewhat diminished in those markets. And so we have to find maybe other ways to add value, simplicity of process, et cetera. So it's always for us a combination decision of where is there real demand from our partners? Where is there real brokenness in the process for consumers that we can go and solve? And where does our technology actually add substantial value to that consumer experience or to our bank partners' experience? And so it's kind of the triangulation of those three things that you have to go and say, hey, where do we want to focus next? Where's the place where we can really make a difference? We can really help our partners. We can really help consumers. And our technology is well suited to doing it. And that's where we'll go. So I think that's how we think of it. Now we're going a lot of places right now with auto retail lending, auto refi lending, mortgages, small dollar loans, and small business lending, all things that we're working towards, some of which are in kind of test versions in market and some of which are, a little farther out. But you learn best from being in market. So we feel like to find our way to the best answer to this question and the best answer to how can we add value for mortgages or auto loans or small business loans, the best way to do it is to get a small product out into a small segment of the market, to see what happens, to learn from that experience, to iterate our way to the best product, and then to take that to market through our various bank and credit union partnerships.
It's really interesting to think about the progression of artificial intelligence kind of slowly, maybe not slowly, but sequentially spreading across different parts of this industry and kind of deriving an answer, right? Like back solving what it is that you need from your borrowers for them to be a good credit. I guess I'm still struggling with the same question, which is what happens at the extreme? And I think about whether these artificial intelligence tools today, obviously they're a really powerful kind of commercial key and they create competitive advantage. But I wonder if some of these tools in the long run don't become, open source, or maybe they become kind of like a public good where the best AI model is the one that is fully scaled to the entire population, right? That doesn't have some sort of like Lemons problem or adverse selection issue or whatever. Is it possible that these things become so core to all financial products or all financial experience that people just have access to them on the fly and they carry them around? Or is that too naive of a direction?
Maybe. I think you can look at credit scores as a version of that, right? The credit scores today from various providers and various score names are trained on almost the entire population, and they're kind of universally used, right? Like everybody walks around and kind of knows that 3-digit number that represents your ability to receive credit for most products today. So it's not a crazy vision that AI models have something like that happen to them. I think we're a long way from that, though, and I think for one of the reasons being. One of the weaknesses I see in credit scores is that, you do have a 3-digit number. But as I said earlier, think about the range of credit products from a $500 credit card to a $5 million mortgage. those are pretty different things. And I would like to think that being an average credit score doesn't make you an average risk for both, right? It makes you maybe a very good risk for one and a very bad risk for the other. We need much more granular models to get us there. And I think we're a long way from having a kind of universality to that approach. I sometimes describe entrepreneurship as creating for yourself the correct next problem, right? Like every business has problems. And the real success is like, do I go from one problem to the right next problem? Because there's wrong next problems too. And I would love if the problem we were facing as a business is your model is so universally used that it's like some sort of a public good. Like, I think we're a long ways off from being there. But there is, at the end of the day, you are right that there is some sort of universal analysis to how risky a certain borrower is. And hopefully AI models will get us closer to that understanding. Because in my mind, when you think about the lending industry, it's critical to people's lives, right? Like access to credit is how we access the ability to buy a house, buy a car, access educational opportunities. It really unlocks mobility and opportunity for the consumer, for the public. And so it's important that we make it accurate and available. And, if you think about what mistakes in a credit model are, they're losses to a bank, but they're really loans that never should have been made and they hurt the consumer. And if we can help the consumer get access to the credit that is good for them, that can help them, but not the credit that they can't repay, that will ultimately damage their ability to get credit in the future, I think that's a huge opportunity to improve the lives of consumers. So it'd be great to see that more universally distributed over time. But, kind of like I had to earn our way to get multiple bank partners, I think we got to earn our way. And really, there's a lot of work to be done to have people confident that models can be universalized and made kind of standard in that way. But that's a long-term maybe vision of what could happen if the models become that effective.
One last question for you around interest rates and the market environment. How does the current macro, which is rising interest rates across multiple geographies and hitting really everything that people are touching, what kind of implication do you think that has on digital lenders more broadly, and then more specifically on the type of products that you're working through? Like, are interest rates things that the way that banks look at them, which is finally you have some net interest spread that we can be profitable on, or is it kind of irrelevant? Like, it doesn't matter what the interest rates are because these are just cycles, and technology goes through all cycles. Like, how do you think about it?
I wish there was an easy answer. You didn't end with the easy question, Lex. That's a hard question.
That's the trap.
And it's a nuanced answer. So if you think about unsecured loans as an example, 75 or 80% of those are typically refinancing credit cards, and credit cards are typically floating rate. So your advantage in underwriting kind of maintains. And in some ways, you could argue the consumer is more stressed as interest rates rise with their current product. So I don't know what that will do to demand. We've never seen it before, but I could make an argument that loans got more expensive, fewer people will take them, basic supply and demand. I could argue that because as rates rise, typically interest rates on loans must rise too. I could argue that on the other hand, in a credit card refi world, your alternative also got more expensive and maybe becomes more immediately painful and you want to weigh out. I'm not sure how that will play out. Obviously, it plays differently in things like secured loans, where people are very rate sensitive. But auto loans is an interesting place now because the price of cars has gone up, right? The inventory of vehicles has gone down. And so there's a lot of things playing with auto retail lending, right? And how auto lending will look. And the same thing is true with home prices, right? Like the lending rates matter for home purchases, but so do the availability of homes, the pricing of homes. And those things are also being impacted by the macro. So every asset class has its kind of interesting in-betweens, interesting nuances to the question of what will happen. And of course, a huge part of that is, will macroeconomic stress cause losses to accelerate, and for how long? And if so, what does that do to the risk appetite of lending institutions? And that's, I would say, a pretty uncertain thing over the next 12 months. People are not really sure what's going to happen on that front. So there's some hesitation. But your question, like, does technology just come through the cycle here and there? I think a smart run company understands that in any environment, there are opportunities. Where those opportunities are may shift. How big they are may change. But if you're putting your resources behind the opportunities, that's pretty good. And whatever happens to rates over the next 6 months, over the next 18, it'll be something different, right? And so one of the things I talk to my lending partners about, particularly people who are, looking at starting a program with us today, I say, well, you may not want to have a lot of personal loans today because you're worried about the future. But in 12 months, that may change. And by the way, it takes institutions 6 to 12 months to make decisions and get ready to go. So in some ways, I think of what you do during the risky environment as laying the foundations to be ready to take advantage of the more favorable macroeconomic environment that typically not just technology goes in cycles, but the economy goes in cycles. And so when there's a tough environment, you got to find your spots, figure out where your opportunities are and focus on them, but also make sure you're laying the foundation to take advantage of the opportunities that come after. And those will be there. And typically you don't have time to build for them when they come, right? You need to be ready for them. And so we're looking at what do we do now, but how do we be ready for what comes next as well?
Thank you for so much insight and color on the industry, the company, the environment, and really fascinating thoughts. Jeff, if our listeners want to learn more about Upstart or about you, where should they go?
We're always easy to find at upstart.com. And the only social media I use is LinkedIn, but I'm pretty active there. So if you want to find me, I'm pretty easy to find, just Jeff Keltner at Upstart, or Upstart, search it LinkedIn, you'll find me. I'm happy to get in touch with folks.
Fantastic. Thank you so much for joining us today.
Thanks, Lex. I appreciate you having me.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.